Now, in the latter part of our curriculum, you've noticed that looking at the style of the manager, very, very important, of course, for evaluation and attribution. Are they a small cap manager, a large cap, focusing on value? And here, when you're looking to select managers, of course, fully understanding what you're looking for and their strengths and weaknesses of the manager is going to be everything here. And so we revisit a couple of interesting ideas. Returns-based style analysis is one of these ideas, and also holdings-based style analysis as well. And they get quite a bit of airplay in this chapter, so it's very important that you have a quick refresher of these before we go any further. But one of the main reasons for looking at style, if you think about, guys, the overall return as being three components, the broad market, the style component as well, and then any alpha or excess return on top. And one of the interesting things about style is that you can nowadays generally get style passively. You don't need an active manager to give you a small cap style or a growth style. You can create that very, very cheaply. So in looking at style, what it allows us to do is to isolate the active value added on top. That's one of the main ideas coming through here. Let's make sure we can clearly classify these potential managers by style, make sure that we get what we're looking for here, and two tools we're going to use, these returns-based and holdings-based. Now, for many years in Level 3, these have both appeared mainly in the equity readings and in the evaluation readings. So here they are really in the evaluation readings. Let's have a look at them in a bit more detail here. So our objective is to better understand what the manager's investment approach is. And I guess what these allow us to do, because we're in the quant area here, is to prove it. Can we back that up in some way through our research? Now, this congruence, if you like, agreement, can we back up and can we confirm that what they're actually doing is the same as what they're claiming to be doing? Now, for many years in equity, let's talk about firstly the returns-based first. Now, with the returns-based style analysis, we're going to construct a regression model to try and replicate here what the manager's doing. And what you might have, for example, here, let's say we have 0.5 as a weighting times small cap value. Let's also have here 0.25, and let's have small cap growth. That just leaves 0.25 left, so let's also have here 0.25, and let's have here, for example, large cap value. So in this returns-based style analysis, we're going to use passive style indices like mid-cap, small cap, large cap, a size style, also value and growth type styles. And what mix or blend of these explains the returns? What mix explains the returns the manager is actually using? Now, put another way, if you were to passively recreate this model, could you kind of copy or replicate what the manager is doing? So what you're able to do, guys, here is to test out to what extent the manager truly is following what they claim to do. With the returns-based style analysis, these coefficients here, 0.5 and 0.25, they're called style coefficients, and they sum to 1. And the factors involved, like small cap value, small cap growth, and large cap value here, well, there can be a whole range of different styles and that the manager might be following. So one of the ideas here is if you were to follow this technique over time, maybe you can determine whether they're changing or drifting into a different style. You know, they call this a style window. You're looking through a window at it changing over time here. So the returns-based, the reason why they call it returns-based, you're looking at these indices to try and explain the returns. If we switch over to the holdings-based now, here you have access to their holdings. As it suggests, you can review what they actually hold in their portfolio and make some conclusions about what style they're following. Let's have a look at this. So these techniques, like our returns-based and our holdings-based, does work best when we can look at publicly traded information. If they're having a lot of private investments, very hard to benchmark what they're doing at all here. Yeah, not going to be quite as useful, but it can be a good starting point to ask further questions. Remember we talked about liquidity earlier on. This is going to come back as a major heading. The minute we invest more in private equity and venture capital, got to be a bit more concerned about getting our money out in the future. So we talked firstly about our returns-based style analysis. Now this regression model I mentioned has an R-squared, and you'll know, guys, the coefficient of determination, the goodness of fit, or the explanatory power. So for many years in level 3, if you saw, for example, here an R-squared of 0.9, if I ask you, by the way, what the R stands for, what does the R stand for in the R-squared? Of course, it's the correlation squared. And so if you had an R-squared of 0.9, it would mean the model that we've created to explain your returns explains 90% of the returns passively. These market indices here, they can recreate your portfolio on a 90% of the returns, but that leaves an error. And guys, that 10% error, in past exams, they might interpret that as more active management. So the use of this returns-based style analysis may be to check a manager's claim. If they claim to be active, but you could completely replicate what they're doing passively, well, it doesn't look like they are completely active at all, and that might prompt some more questions to check a bit further in there. So being able to passively recreate, very, very useful test of the degree in which they're active here. Now, the range of factors and styles that managers can follow, we know can be quite diverse, whether it might be large cap, mid cap. The slides talk about it working best for equity areas here. One area might be quite tough to do though, if you're looking to bring in a hedge fund manager that might not have a lot of market risk at all. They may have strategies with very little market risk, very hard for this strategy to work too well. Now, we're coming on to the problem of liquidity. And I mentioned before, how do you handle, particularly when we have more appraisal-based pricing? Now, when you think about the global investment performance standards in level 3, you think about 2 different asset classes. What are they? Guys, what are the classes that are coming to mind? Well, of course, real estate is one of them, and then private equity is the second one. And the nature of these two, where we have a valuer or an appraiser goes out to value, we don't have a steady stream of transactions every day. So when we have to rely a lot more on infrequent appraisals, we know it's going to be a bit of a problem in terms of our data. And one of the problems that you've seen before within level 3 is that the volatility is smoothed. This idea of smoothed and smooth returns means that the level of volatility tends to be downward pressured, much lower than it really is in real life. Yeah, understates the risk exposures here. Now, because of this issue about data frequency, the timeliness of reporting here is going to decline. The more liquid it is, and that fits very well with the rules on GIPS. Just as a quick reminder here, if you haven't had a chance to see it for a little while, but in our CFA GIPS, the normal requirement for reporting would be normally at least monthly or more frequency if you have a large cash flow. But for things like real estate, normally once every 12 months, you're looking for some kind of an appraisal, or if the client agrees, it can be as infrequent as every 3 years, which is quite surprising. So onto our holdings base. Now, for some kind of investment firms, they might call this a snapshot. You get a snapshot of their holdings at a particular point in time. Some types of investment firm won't show you them at all. Hedge funds might not release these, of course. But let's say you do get a good list of what they are holding. What can you infer about their style? What can you infer about this? And again, moving back to the equity chapter here, lots of info you've seen already about this. Looking at things, guys, like, for example, like PE ratios, you have a very high, for example, high price to earnings. People, you have to pay up for a current good performer, a current high earnings deliverer. You have to pay up for that. If you have perhaps quite a low PE multiple here, then you're more down the value. That's the value style. Here's the growth style. Quite low because the price is low for a reason. Perhaps the risk is quite high. That's more of an underperformer. Maybe over time that underperformer will come back and that outperformer will kind of start to drift back towards the mean, of course. But the idea of trying to analyze what they're currently doing. So in the holdings based here, you have got things like value and growth. You have got the mid cap, large cap. Talk about micro cap as well too. Now, yeah, the more complex the styles, perhaps the tougher it might be to pigeonhole into a nice and neat category coming in here. And also a bit of a concern, what about again the liquidity problem where you might not be able to classify them quite as easy. I quite like this because it's relatively new. It's new for 2020. Always nice to see something a little bit new coming in the syllabus. But you have met this before. It won't be new to you in the evaluation reading. So guys, if you haven't had a chance to look at that one there, have a look at the evaluation, but here's a quick summary. So capture ratios could be a calc coming in here and in the evaluation area. And it's the idea really of comparing your manager or fund versus the broad market. And firstly, number one, let's have a look at the upside. They call this the upside capture ratio. What we're saying here is if the market rises, well, how have you done in comparison to the market? The market is the benchmark, so if you have exceeded, guys, the market there, then your upside capture ratio will be positive. For example, if the market's risen by 10, maybe your fund has managed to rise there by 12, because you've outperformed on the upside here. Now that's what you'd want, of course. You want someone who can outperform on the upside. What about the downside? So the downside capture ratio here, this time when the market is falling, say the market here is falling, I don't know, by 10% perhaps, have we managed to limit that fall at all? Maybe here we've only lost perhaps 8, where the market's lost 10. So you've more of the upside and less of the downside. And that's exactly what we're looking to measure here. Have you managed to limit this? Think about, for example, level 3 in a big picture for a moment. Have you positioned your portfolio to benefit more in terms of being more sensitive to the upside perhaps by increasing your beta or by your duration? And have you kind of been more defensive minded when you've seen more tough times coming our way? Now, putting it all together, if you have managed, guys, to kind of add value, if you've managed to add value there, and also manage, guys, here to kind of limit the downside, then you're going to get this convex payoff. And I want to remind you here of this from other areas. When you think about this convexity here, you have seen this before, of course, in our bond, our fixed income area here. And notice, guys, here you've got more of an upside and you've got kind of less of a downside here as well. Whereas the market here, the market rising, the market here falling, we have improved in both ways here. So where we have the ratio being above 1 here, we are in fact benefiting from here. But of course, if you were to draw on perhaps on a dotted line here, where someone has a double whammy of bad performance, where you have less than the market on the way up and a bigger fall than the market on the way down, sometimes perhaps your timing is a bit off. So this whole issue of upside and downside, a few little add-ons before we leave them. The idea firstly of momentum-based strategies, thinking about them here. So the idea of if when the market's rising, have we managed to add a bit more on top? These momentum-driven strategies, they should have a higher upside capture than value-driven strategies that are not kind of being drawn to stocks that are rising right now. So momentum picks up on recent momentum, whereas value is more of a contrarian view. It's this idea of how you position yourself in the markets. Think of it, guys, logically here. If the market is about to rise, now how do you benefit from that rise? If the market is, you think, going to fall, how do you cushion that fall? And it might be, guys, a switch over here to a lower beta strategy, maybe more hedging going on as well. That might be one of the ways. So one of the main ideas here, I suppose, is timing. Now, timing, have you managed to foresee these market conditions? Have you managed to position the portfolio to benefit in this way? Very interesting area, which are drops. Guys, a drop or a drawdown. Here's a high point and here's a low point in the portfolio. If you're going to be measuring this, it could be, I guess, very frequently. It could be looking at a daily drawdown. It could be a weekly or a monthly drawdown as well. But this kind of peak there to a trough. When you're measuring this, by the way, think of it like a holding period return. There were a few questions in the past where you might have had to calculate this years gone by, but you've got the ending value. That's perhaps time 1 over the beginning value, the start of the period, minus 1. So this idea of how much of a drop it is, here's the beginning. Perhaps it began on an increase and then it fell. There's the end value here. So if you're asked to measure that drop. Now, one of the reasons why hedge funds especially like this kind of metric is because we're not relying upon any type of distribution. Whenever you think about standard deviations, relies upon a very convenient normal distribution, whereas drawdowns are quite intuitive. We know what drops are. There's no kind of fudging them with data. People understand them. Now, maximum drawdown, the largest drawdown, could be a useful metric as well. If you think, though, from a client perspective, when would you particularly be worried about that kind of drop or signal if you're a client? Imagine you're approaching retirement. This glide path, I love that term, that glide path, probably because I'm gliding myself at some stage, but gliding towards retirement. Imagine as you get closer towards, your goal in sight, massive drops in the portfolio. And so very often to avoid this, we know that the allocation might start to be changing, often 10 or 15 years earlier, to take away some of your exposure to those risky areas. That kind of glide path, you're starting to plan much earlier. Other thing you might want to think about here under drawdown ratio, think of it more as a ratio here. You might have the maximum drawdown here, for example, and then compare that perhaps with return. Return over the maximum drawdown, having more of a risk-adjusted return, if you like. Now, drawdown duration is the total time from when the drawdown begins to when the drawdown recovers. It's quite an interesting little bit on here that I thought from the text, which is the manager's reaction. What's the manager's reaction to the drawdown? Do they panic? Is there a panic? They give a good example about 2007. We're back to the crisis period. I think it's the August the 7th or so, 2007, when markets fell. Did your manager panic? Did they panic and sell out immediately? If they did, they would have missed out on the resulting rebounds. So losses would have been made by panicking in that scenario here. So this idea of looking back perhaps over drawdown periods, especially at what the reaction was from the managers, because this drawdown duration is saying that should be related to your investment time horizon. If you're investing for 20 years, why would you panic when markets have fallen in one day? Yes, so the controls, how you're operating your fund, the ethos and your main strategy. Are you overreacting, underreacting? If you have a long-term strategy in view, think of it more like a strategic asset allocation, then why would you immediately pull your money out on that one day? And what we're trying to do here is to relate the manager's experience and background to, of course, our investors. Do they have a short time horizon, trying to match the right manager to the right time, to the right IPS?